there is more upside in this downturn than there has been for the last 10, 20 years. And the fact is that there are more distressed assets because there's distressed owners. Not that the properties are troubled, but because these buildings weren't properly structured in a good financial foundation, and they're troubled today. So it is an incredible time to be taking advantage of the downturn.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today, we're back with Patrick Grimes. You heard him yesterday talk about how he lost everything, how he came back out of that, how he's not speculating anymore, and what that means exactly. He even dove into some partnership things that I think is very helpful for you that are thinking about partnering with someone, right? I get questions about it all the time about how I started to partner with people, how we started to grow through those partnerships. And he elaborates on some of the same exact things and then some that I know is going to be helpful for you if you're considering it. But also, he's diving in today to, what does that deal look like today, right? It looks different than it did 24 months ago, right? Even 12 months ago, it looks different today, how you're putting that deal together. What does the structuring look like? What kind of reserves did he have? He talked about surviving, a recession and deals that he has now that are doing just fine because of the things he put in place, which, right? It's why he survived, because he thought those things through. He's going to talk about a number of those things as well. Patrick, welcome back to the show. Honored to be able to do a series with you, or do a couple shows. And I want to remind the listener to go back and listen to yesterday's segment with Patrick. He talked about how he lost everything in the recession of 07, 08, what happened, but ultimately why it happened, and about speculating and some lessons learned that I know you need to know. I don't care if you're active or passive, some lessons that you need to know about investing. Today, we're going to jump into his thoughts on leaning into the current recession, and really, what does that look like? Finding the upside in the downturn, or in a deal right now to Patrick. So, Patrick, welcome back to the show.
Well, Whitney, I've been told about your podcast by so many people. Now I get to go back to those people and say we doubled down. We did it twice, so double the fun.
Awesome. Well, let's jump right back in, Patrick, and let's do just that. Leaning into a recession. Maybe at first you could kind of give us your thoughts on just the current state of the economy, or current, where we're at as you see it. Often I ask this question. People say, "Well, I don't have a crystal ball." And I say, "Well, yeah, I know, but what you believe is going to happen affects what you're doing right now, right? It affects whether you're buying or selling, or what you're doing. So, why don't you give us just a few thoughts on that? Let's dive into finding that upside, even in today's market, like we've talked about.
The long story short is that there is more upside in this downturn than there has been for the last 10, 20 years. And, when it was Warren Buffett that said, when others are greedy, be fearful. Right. And that's been the last 10 years. When others are fearful, be greedy. And that's now. While I don't like the emotional aspects of that, because it kind of violates that engineer analyst in me, because I don't think we're driven. I'm an analyst. And the fact is that there are more distressed assets because there's distressed owners. Not that the properties are troubled, but because these buildings weren't properly structured in a good financial foundation, and they're troubled today. So it is an incredible time to be taking advantage of the downturn. And it was back in 2008 and 9, people like me that didn't build and hadn't built a recession-resilient portfolio lost everything. And I came out of that learning how, and to made the journey of my life being how to build something that would ride out a recession, right? And better longer-term debt that doesn't have variable rates or caps, low leverage, in recession-resilient markets and recession-resilient asset classes with reserves, 6 to 8 months of reserves in case we get hit by a financial disaster like a COVID or even a natural disaster. Insurance, replacement costs, all these things help to build a recession-resilient portfolio leading up to today. But today is a new day. Because anytime you're building recession resilience, you got to look in history to see, well, what happened? And then how do we fortify this system to survive things that like what has happened before? But in any case, if you have a watch, it says it's waterproof to a certain depth. You drop that to a certain depth and it's going to crack, right? So recession resilience is similar. And today things are very different than they have been. I don't think you would disagree with that, right? When you,
Definitely not. They're very different than they have been for sure.
yeah, so the factors of today, which even very, very strong operators who had very low leverage and had been conservative about their projections, they got fixed or even interest rate caps to protect from rising interest rates. They had reserves that were buying properties with the intent of raising value over time through renovations. How could they even be struggling? Well, a number of things happened. Going into COVID, all of a sudden, people's jobs disappeared, right? Or the government started putting trillions of dollars out there. And so, what happened then? Well, what we've learned is that that results in inflation. Now, and in 2009 and 10, we didn't have that dramatic inflation, right? So a little bit different indicators than we had now. I actually have an article in Forbes, Patrick Grimes' Forbes Inflation, and if you want to search for that, it talks about how income generating real estate can actually help your portfolio grow in an inflationary environment. In that same article, which was written pre these last couple years, I talk about the underlying assumptions are that when your expenses grow, track with inflation, and your income tracks with inflation, and you have fixed debt, right? What we're seeing is that the expenses are actually outpacing inflation, and the debt is growing as well at a greater rate. So it's a little bit tougher. When we go into an inflationary environment, your expenses go up, right? Your rents go up too, but your expenses go up. Now, if it was just your expenses and rents going up with inflation, you'd be okay. But in many of the favorable locations to invest, like in the southeastern states and Texas, at the same time, insurance premiums have doubled and almost tripled in some areas, at least 20 to 30, if not 50% in places like Florida and Texas. A lot of the insurance carriers that, whether or not you believe in global warming, we have properties that have been hit with 2 500-year floods in the last couple of years. There's so many large claims happening in these areas because of the greater number of storms. For whatever reasons, insurance is getting hit hard. Leaving COVID, taxes are rising. Taxes are rising because these government institutions are trying to pay catch up, just like the insurance carriers. Meanwhile, our costs for construction, the inflationary costs for construction are going up, not just because of inflation, but because of the scarcity of the supply chain resulting from COVID, right? So these are things that are rising our costs, not only in the materials, but they're delaying things, which costs more. And in the labor content, this great resignation where everybody went home and didn't want to come back to work, it's harder to find those jobs that will do the renovations and the construction, which means we're having to pay more for those jobs, further exacerbating the inflationary measures and further delaying things, right? So you have this aggregating cost of materials, delays, labor, delays, insurance, costs greater amounts, and taxes. And it's going to consume a lot of these reserves, a lot of these conservative, the underwriting things that a lot of these strong operators put in place. But then we have some other things which have tacked on and been even more devastating than all of that happening. Rising interest rates over time for operators that had variable rates have risen to the point where they are completely upside down and aren't able to pay their bills at all, especially with all this other stuff going on. If they had a rate cap, then their income was further hit until it met their cap, right? If they had fixed interest rate, then they're probably in good shape as long as they can bridge past this time. So interest rates have further exacerbated this. And when all of these costs go up and interest rates go up, the income goes down, which shifts valuations of the properties, okay? Valuations of the properties are actually lowering. And if the debt comes due at a time when the valuations are low and you don't have the ability to raise rents because you can't do it in time, the labor's too expensive, it's too scarce, the materials are too expensive, too scarce, and you can't get people out, because right now the courts are backed up with COVID evictions, then you can't actually improve your income, right? And so today is a very unique time where there's 1.5 trillion in commercial real estate debt coming due by 2025. And I've heard reports that 200 million to 500 million of that is expected to be in a distressed situation where they're going to need to recap or renew their loan at a time when their valuation has softened, at a time when they're trying to get the tenants out that aren't paying still from COVID, and they have all of these high pressures, and it's throttling back their ability to execute their business plan to raise the rent income. And so even if you're a very strong operator, this is a really tough time. This is a really tough time for you. And that's okay. And the reason why you hopefully had long-term debt fixed with low leverage, 8 to 9 months in reserves, and insurance costs, replacement insurance costs, and all these things leading into this was so you can ride it out to the other side, so the capital's preserved. Unlike in the stock market, where if you had invested, you'd have taken massive hits on your principal. Right now, your investment's preserved, but that doesn't mean you do the same kind of deal. Or Whitney was saying, how do you in this environment, how do you put a deal together that makes sense today? That doesn't mean you do more of the last year's deals and the years before that.
It better look a little different today than maybe 2 years ago, right? Or it's going to look different. You had mentioned, structuring it the right way and reserves and some of those things, which we've all talked about, but probably looks a little different, like you said. Dive into that a little bit. What does it look like, structuring it different today to make a deal work today versus 2 years ago? What does that mean, structuring it the right way?
So structuring a deal today, if you look back at 2009 and 10, when there was distressed, good properties, right? But distressed ownerships, distressed financing, distressed debt, right? It's very similar to what's happening right now. There's so many performing properties out there that are good buildings. They don't need huge renovations. They don't need to be gutted, but they have distressed foundations and financial foundations, and that they're coming due, and there's an issue. There's a lot of similarities. And what happened in 2009 and 10 was that wealth transferred and people became billionaires, or they lost it all, like me. And so the chance right now is to take what was similarly a short period of time, like in 2009 and 10, to buy these assets. Like now, we have a huge amount of deal flow of not distressed properties, but distressed ownership, right? To buy these, but you can buy them at a discount today. And instead of trying to buy something that's troubled and needs a lot of work, where you need to hold it for a long time, for 3, 5, 7 years, and you're going to have to spend a bunch of money to renovate, which is expensive and time consuming, and you can't find the labor and will take a long time. Instead of trying to buy a property and then trying to improve it to 99%, right, over a long period of time, the time with a strategy in this kind of market is to make your return on the buy. And then instead of holding as the market softens, you want to hold and write it down. You want to make your money on the buy, and then you have to, by the way, these are difficult to acquire because there's lots of people out there looking for them, and there's lots of deal flow for these distressed ownership type assets, and it's only going to increase as we approach 2025. But so you buy in cash, and then it's like whack-a-mole. You pick it up real quick, and that's exactly what was happening in 2009. Buy a second property quickly with that. And then with your first property, do it a tax advantage exchange forward to a third property. And then you immediately, with short-term holds, do that same thing with the second and the third property. So by that, instead of long-term play and perfecting one asset with a lot of work, you rely more swiftly on buying, making a return on the buy, and then compounding that into 2 through a refinance and a tax advantage trade, and then compounding that into 4 and then 8. And then by that, you have a lower risk strategy, because you're not gambling on inflationary measures. causing issues with a value add strategy. You're not gambling on the ability to get people out in an environment where evictions are backed up. You're not gambling on the rate, what the values are going to decrease to in 5 years, right? Because you're making a return on your buy and then you're trading it forward, and making a return on the buy, trading it to make a return on the buy. And if you continue to do that and more, you compound, and as you get 1 to 2, 2 to 4, the rent checks will grow, the cash flow will grow, because although you're getting smaller rents these days, once you compound one asset to 16, you're going to have greater cash flow. And although you wouldn't get the same potential equity you would get by holding one asset for 5 years, you will get vastly more equity if you compound one asset into 16. And so that's what I believe is the strategy today. It's the buy in cash, the refi if you can, buy a second, trade forward, compound your equity, compound your cash flow, and take advantage of this very short window. Don't hide under a rock. Don't put your money in savings accounts. That's negative return with inflation because you're in fear. But be greedy when others are fearful, and move swiftly and with agility. Take the opportunity to buy as much as you can. And that's why, and I've been waiting for this for a long time because I lost everything last time. And I have a portfolio that's going to ride this out, but I'm also launching the Recessionary Acquisitions Fund and the Recessionary Debt Fund as a complement to be able to take down as many properties as we can in this buying window. Pretty exciting.
Yeah, that is exciting. I appreciate you really just laying out some very clear strategy and a few things that I think every investor should be thinking about as they're buying properties, or hopefully they're not just acting out of fear and just doing nothing, right? Is the challenge, I think, especially if you lost a lot, right? Before you're going to be so hesitant. You've been hesitant. Maybe it's been a good thing, right? To some degree, but now you do have to take action. And one couple things though, I wanted to mention. I get questions about reserves all the time. I'd love to know how you thought about reserves. Let's say a year or 2 years ago, and how that's helping you in a recession now. And has that changed how you look at reserves, when you're buying projects moving forward?
So virtually all of our decks have had advertised similar metrics, which has said 6 to 8 months in reserves, which means one day we wake up and we get no income. We can float the property for 6 to 8 months. That gets you the ability to do a lot of pivoting, right? Because during that time, you can build an entire building. You can restructure the debt. You can so if there's a hurricane or a flood, natural disaster, you can get yourself back on track, and then float the property in time float the property up front in time for the insurance company to come back and pay the replacement costs for rents in the building. So we've always had that. And in the case of COVID, the unexpected happened. When all of a sudden rental assistance checks started coming in, we thought we were great. But what happened? Rental assistance checks stopped. And then what happened? Rent payments didn't resume. And then what happened? A much bigger financial disaster hit than a hurricane because the courts were already backlogged. The wave of evictions when the eviction ban came up was so big already that when virtually every landlord in the country filed for evictions for these people that hadn't been paying for years and didn't resume, places where we could usually evict in like 2 to 4 weeks in Texas, or a month or two in Atlanta, became 4 to 6 months. So now here you're hit with all these other economic challenges. Meanwhile, you have tenants that aren't paying. They know they don't have to pay because they know everybody's not getting evicted. And for extended periods of time, that means you can't even get them out to renovate, to raise rents. So that kind of economic disaster was never foreseen, but those kinds of economic and natural disasters are what the reserves are for. So if you had those pieces in place and the foundation, you should be good. To answer your question about moving forward, we have the kind of the luxury. There's actually 4 assets that we've stood up as outside of a fund, which demonstrate the kind of our recessionary acquisition strategy. And you can read on our deal page that describes kind of how they were played out. But we're going in buying it with the actual occupancy. Some of them are 40, 60, 70, right? These are properties that need a lease up. They're good performing properties that need a lease up. They're properties that we know before our earnest money goes hard, we can see a bridge to getting, 1.8 equity multiple in a short period of time. And we're actually saying 6 to 14 months on the conservative side. But we are putting the similar kind of reserves in place, but we don't have any intentions of needing to use those, because the minute that we go in and we're the source of relief to the distressed owner, right? For financial relief, we can come in and we can offload this from them. And maybe it's this asset that's causing them trouble. And in one case, it was actually the other assets they owned that was causing them trouble. And this was a great asset. They just had to offload quickly so they could use that cash flow elsewhere. We are putting similar reserves in place today, but our intention is not to have to hold it long enough to even the amount of reserves we have, because our intention is to hold it for such a short period of time that we can immediately just go to the next buy and the next buy.
And when you say 6 months of reserves, what does that include exactly? Is that debt service as well? Is it just expenses? I've heard people say different things. I just wonder.
Operating expenses, not debt reserves.
Yeah. Typically, your debt provider is going to require reserves as well. I just heard different people say different things that they're including in that. So I just wondered. Well, Patrick, I want to jump to a few final questions, and I wonder, like, what would you say is the biggest challenge in your business right now?
Well, I'd say the biggest challenge in our business was that we have been putting together the recessionary acquisitions fund and then repivoting and resetting investors' expectations, because there are a lot of syndicators out there packing the deals which are similar to last year and the year before, and they don't look any different. And the biggest challenge for me is to explain, and I'm talking in front of 600 people, in San Francisco on recessionary acquisitions at the MFIN. And I'm getting out on podcasts to talk to people like, hey, look, I was the guy that lost it all one time. Now's the time to do things very, very differently. And I think the message has been received. I think there are investors out there that are getting it, that you can do things dramatically different today and win big, with instead of long and short holds, and instead of buying in cash, instead of buying with leverage, and all these things that seem counterintuitive but make sense today. And I think it's been working well. The first acquisition in the fund oversubscribed before we sent an email out. So there has been a pretty big draw towards the strategy.
That's awesome. Oversubscribe before you even send an email out. That's a good problem to have. On that train of thought, what's your best source for meeting new investors right now?
So I come from that automation and robotics engineer, keep my head to the grinding wheel, don't do a lot of flashy marketing. So I don't necessarily have, here's my metrics of, the hard funnel data of, but I do get a lot of investors setting up calls with me. I think that it's hard I don't actually have all the numbers together, but I do offer the book. I get on podcasts, and I'm excited to finally be on Whitney's here today. I get on stages about every month. I'm speaking on a large stage around the country: Seattle, Houston, Dallas, San Francisco. And I think that I came from a high-tech background, and so I have a large following of entrepreneurs, business owners that have invested millions of dollars in high-tech automation solutions. And that's how I got started. And I think kind of that reputation kind of grew into now a broader audience of investors that are resonating with the analytical analyst approach and looking to invest with somebody who's seen the worst and fought their way back in. So, yeah, I can't really. Sorry, I don't have an answer for your question.
No, it's all right. You're doing a number of things, though. I mean, you talked about speaking, being on podcasts and whatnot. And to be able to raise, or to oversubscribe before you send the email out. You're doing something correct, right? How did those people know about the deal? Did you call them? How did you notify them? How did they know to subscribe?
Yeah, so we put a up and coming thing on our website, and I've been talking about it on different platforms. we send out weekly emails. Just this is what we don't say. We don't say, hey, a deal's open. We did say recessionary acquisitions is something we're working on in the future. If you're interested, opt in on the wait list. And so we did send those kinds of emails out. We have about 10,000 people on our database. We had about 400 people express interest before so we never actually launched a raise for that. We just tapped into that priority queue.
No, that's awesome. What would you say is your best advice for passive investors today?
I'd say invest with somebody who's been through, a tough time and is still kicking, because the get rich quick or the glamour of being an operator, once the going gets tough, you really get to see that kind of the true character come out. And if they went through that tough time and then they made it out and they have reasons and can articulate, this is how I'm not doing that again. That's what the VCs look for in Silicon Valley when they invest in startup owners. Startup owners that say, hey, here was where my failures were, and this is exactly why it happened, and how we're going to make it out. And so I tend to vote for people that have been through that kind of journey. And those are the people that I was on a panel in Chicago talking about economics, and every single other person on the panel had lost big before. And I thought it was really interesting because not very many people will talk about economics today in this market, but a bunch of people who had been through the dirty failure and loss, and seeing how the economics that can shift, the demand can shift, and how the models can get turned upside down, and that watch can go so deep that it cracks, right? And those are the people that have learned through the crucible of failure. And I tend to put my vote in that basket.
What are the most important metrics that you track? Could be personally or professionally.
So personally, my wife and I, we try and make personal time happen on a regular basis. So we try and get out on regular dates between the two of us. And we actually now that we've had our little one, that's been a little bit more challenging. And so we have an au pair who's arriving today here in Hawaii from Paris. So she's literally on the opposite time zone. And so that's going to be great because we're going to have some more time. But we're both very much adventurers. And so we try to get out on, monthly excursions and events. And we try to get out on walks. And she even went kite surfing with me here on the island. So that's perhaps the most important one right now is that. And then doing my daily time with my little one that I carve out both in the morning and in the afternoon. On the business side, we have all kinds of metrics. We show our returns, we track cash flow, we track investors coming in. We have kind of like this no investor left behind thing where, we review, where all the questions that are coming in, make sure everything's getting answered. There's just a bunch of rabbit hole stuff that we could get.
Yeah. No, that's helpful. I appreciate that. One of the first things you mentioned is the family component, right? The time, with your wife and now with your child as well. And I've talked about it so often on the show. Those are often, unfortunately, the things that get pushed aside. It's what we claim we're doing it for, right? But those are the things that often get put on the back burner when we're over here doing all this work for them. You're right. And they unfortunately aren't a metric, or we feel like they shouldn't be a metric, right? Because where they're so important. Well, often if you don't make it a metric or put it on the calendar, it doesn't happen. I know that for myself anyway. So I was grateful that you mentioned that first thing. What would you say is the number one thing that contributed to your success?
Persistence. So to a fault, I'm a persistent guy, and that's why it was so interesting that I did the Persistence, Pivots, and Game Changers book, right? Because the industry I chose of machine design, automation, and robotics is a highly risky industry where everything you're doing, you're inventing for the first time. It's a one-of-a-kind custom machine design product. And we were doing those for like Tesla and Lockheed and Boeing, and where we come in and be like, hey, this is the only one of its kind. It's a gizmo or gadget or product or device or medical device, whatever. Can you build one of these one time? And the whole process of design and development is overcoming failure and being persistent. And even though we built the 3D models and we did the calculations and it would never go to plan. And then we had to adapt and then we would use lessons learned moving forward, but the next thing was totally different. And I think, was it Winston Churchill who said, he never won a war that went to plan, but he never won a war that he didn't plan thoroughly. And then there's another one that's, if you ever find yourself traveling through hell, keep going, right? So I think that persistence and pivots, and to a fault, my wife sometimes has accused me of being super persistent. So
yeah, that's some good quotes as well. I love the persistence. I mean, you have to be, right? If you're going to be successful at almost anything. How do you like to give back?
So my wife and we're actually working on that now. Now that I've kind of left the engineering and we're full time on this, we participated in a bunch of activities related to Salvation Army. We were out in Florida with Rod Cleef, participating in giving back the gifts that he gives to the Boys and Girls Club, and we've done a bunch of charitable giving. My wife has a passion she does feature-length animated films. And she has a passion for helping out young artists. She actually works on the other side of this door as a production manager, and she's done large feature-length films with Disney, Nickelodeon, and DreamWorks. And so she wants to give back to Cal Arts, the school she went to for a master's, to kind of sponsor struggling artists to make their dreams happen. We've got a ton of little things we're doing here and there, and we're working on a version of passive investing mastery, which is another branch of Invest on Main Street that does alternative investments but passive giving, right? And the ability to create that foundation, kind of formalize it. But that's in our short-term sites and our short-term goals, to really formalize that and kind of go from, oh, let's do this, let's do that, do this, like, here's our vision, and let's really do something cool.
Love that. Patrick, I'm grateful for your time and giving back to us in the audience over 2 segments here, and diving in today on, putting that deal together today, right? In this economy, today, what does that look like, and structuring it the right way, and even thinking through reserves and building or thinking through the recession resilience, right? What does that mean to you? Just grateful for your transparency and being willing to help us and the listeners. How can they get in touch with you and learn more about you?
Yeah, so Patrick at investonmainstreet.com. Patrick at investonmainstreet.com. If you go to investonmainstreet.com, at the top, you can see we have some upcoming deals, the Recessionary Acquisitions Fund, the Debt Fund. We have a multifamily placeholder right now. We have some other alternative investments coming up. We've done diversified energy funds before. We're really trying to give that opportunity to diversify 25 to 50% of your wealth into alternative investments. And so if you want, there's the ability to schedule a call with me, please do so. I love talking to investors. One of the things that I love doing about the fact that I left my engineering career, now I get to just invest in people. So investonmainstreet.com/contact. My calendar, I don't have a ton of availability, but I absolutely have it. Happy, wherever you're at in your journey, happy to get you pointed in the right direction. And if you want to hear my story, that book, Persistence, Pivots, and Game Changers, Turning Challenges and Opportunities, Brian Tracy did the foreword, and Phil Collins did a chapter. He's the lead guitarist of Def Leppard, an actual rock star. And we have some NFL, NBA players and entrepreneurs. And it was an amazing project to be a part of. It's such a great time. I tell my whole story for the first time. I get it all out there, the dirty and everything, of the grind, getting raked over the coals, and then pivoting again and again. But we give it away for free. I bought a bunch of them. I think it's fun book, and if it helps to inspire you, then that's enough for me. So if you go to investonmainstreet.com, invest on, and then main, and then street.com/book. That's the secret link. And you go on there and you put in there Whitney's name or the name of this podcast. We know who you are as the promo code. You're not some random. We will work on getting you, and I'll sign it, a copy of that book shipped out to you for free.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.